Hello, and welcome back to Equity, TechCrunch's venture podcast. I'm TechCrunch reporter Kate Clark, and I'm joined by the driving force behind ExtraCrunch, Danny Crichton. How's it going, Danny?
It's going well, Kate. We are recording on location today from TechCrunch's Session Enterprise event, where we're talking to everyone on the enterprise infrastructure and SaaS markets.
Bear with us if there's a little background noise. We are live at the event, like Danny said. So we have a special guest with us today, Jason Green, the founder and general partner of Emergence Capital. Hi, Jason. Welcome.
Hi Kate. Hi,
Thank you
Danny.
for joining us.
Great to be here.
A little fun fact about Jason, and Alex isn't here to say the fun fact this week, but Jason is a twin, married to a twin.
That's right.
And you don't have any twins, which you've informed us of.
We don't have twins.
What a mystery.
We had a lot in common. We know how to share.
So just a quick background on Jason before we get going. He was an early investor in a ton of well-known enterprise companies, including Box, Yammer, Steelbrick, SuccessFactors, Visual Networks, Service, Max, and DoubleClick.
Yeah, and Emergence was started really with a 100% focus on enterprise, and we've been around about 15 years.
And when you started, were there many firms focused solely on enterprise?
I actually don't think so. I mean, certainly I was at another firm before starting Emergence, and we did a lot of enterprise investing, but as a focus of the entire firm was quite unusual, and frankly still is unusual today.
Yeah, you'd think there'd be a lot more specialty firms like completely focused on enterprise.
Well, we're glad we did.
So as we are at the enterprise event, we are planning an enterprise-focused episode, but there was some big news that dropped this morning that we felt like we had to talk about.
Yeah, so overnight, the Wall Street Journal reported that WeWork's investment bankers and its corp dev team are potentially cutting back its IPO price from $47 billion to potentially as low as $20 billion, which is actually lower than the secondary that SoftBank bought a year ago from WeWork employees. And so this is huge news, right? So the S1 came out, I want to say 2-3 weeks ago, and it clunked on Wall Street. Everyone looked at this and I think is really seeing the losses accumulating quarter over quarter, along with sort of macro factors, U.S.-China trade, the challenges in real estate, slowdown in GDP. And so, net, it looks like WeWork's going into a really tough era.
Right. I mean, like you said, there are tons of factors. There's also the fact that Uber and Lyft, have not performed well. This is another decacorn company going out, and I think Wall Street's skeptical. So WeWork is expected to potentially begin its roadshow next week, but do you think there's a possibility that they might delay their IPO entirely?
From what I understand, that they are in discussions with SoftBank for another potential private market financing.
When does it end?
So I guess when SoftBank runs out of money, which doesn't seem to be anytime soon.
Certainly, yeah. I mean, they've got another $90 billion lined up for their second fund. Yeah. There was news today that they've lined up the Abu Dhabi State Fund to invest in Vision Fund 2, which we weren't sure of. Yeah, so
That's a big deal, yeah.
Exactly.
The Mubadala, the Abu Dhabi Sovereign Wealth Fund. Look, I think it's interesting we looked at a bunch of companies in this space, and you look at, say, Datadog, which seems to be doing really well, and we'll talk about it in a little bit. But, the numbers actually do matter at some point, right? And I think there is this translation from the private market. Exactly.
The numbers
That's why you're in
matter.
enterprise. See, consumer, it's never about the numbers. But in enterprise, at some point, the numbers catch up with you. And I think for a lot of the investors on the public markets, they're seeing this and saying, look, the raw economics were not there. There were huge gaps in the S1. I read through it at a bad morning of reading through 400 pages of legalese.
Good for you.
It's like there's just no good numbers in here.
Yeah, and some questionable governance issues as well.
That's right.
And that's
Absolutely.
been raised in prior companies, but in particular in this case, where some real interesting
There's some weird things going on.
Well,
Yeah.
and that was the other news story in the last 2
Mhm.
days is Adam Newman has handed back the $6 million he was paid for the trademark for the company that he founded.
Yeah, very strange.
and the last WeWork note, they also did finally hire their first female board member this week.
That's right.
I guess better late than never, but also extremely late. And that is Frances Ray. I'm not sure if I'm pronouncing that right. But she was the woman who also joined the Uber board amid crazy harassment allegations.
Wow.
Interesting choice, but good that they finally made that step.
But talking about other challenging stories, so Slack also had its first post-IPO earnings yesterday after the bell, and it looks like the market was not pleased with sort of the performance, despite the fact that it actually beat the market on revenues, 145 million against 140, which was sort of the analyst consensus. But it looks like the long-term growth pattern, a lot of the Wall Street investors sort of stepped back and said, the story is not the same as we were thought in the IPO.
Yeah, I mean, I think as is the case with any time a company, makes their very first or releases their very first earnings report, there's always a lot of, I think, criticism no matter what. But Slack did end up dropping 16%. What was your take on this, Jason?
I was surprised. I was a little surprised with the negative blowback on that. They beat their guidance and consensus. They raised their guidance for the year. clearly not enough to meet investor expectations. But let's remember this company is really 5-ish years old and is a $500 million run rate plus business
Mm-hmm.
and 100,000 plus customers. I mean, it's been an extraordinary success story. It's just priced as many of these companies are for perfection. And so when you don't overachieve wildly, you do get hit pretty hard. But I think in the long term, it'll play out fine.
Yeah, and in today, Slack's trading at about $30 a share. That's low. That's down from its high of $42 a share. But I have a feeling things will kind of even out.
Absolutely. And Jason, have you been sort of paying attention to this kind of pullback in the public markets around SaaS valuations and multiples?
Well, it's interesting you call it a pullback. We're almost trading at all-time historical highs in terms of multiples. And we've been seeing trading, for instance, Salesforce, which we've been investors since 2002, has ranged from probably a 4x multiple to 20x multiple over the years. Probably is trading at an 8 to 10x multiple today. Companies like Zoom or Slack closer to 20x multiples. So even a 10% pullback, you're still talking about historical, very significant valuations for these companies. I think everybody should be happy, frankly, where things are right now, and hopefully it'll stay.
Great.
So we've got a lot to get through. So let's move on to a couple more IPOs that are expected very soon. CloudFlare this week did price their IPO. The company plans to trade between $10 and $12 per share, which values the company at as high as $3.5 billion.
CloudFlare was actually on our stage many, many years ago, and our Battlefield was a runner-up, so has done very well in I think it was 2009, so a decade ago. So it's amazing to see this company kind of go IPO. Really solid business. I mean, I think we cover a lot of the policy and challenges they face in terms of websites and the Daily Stormer and a bunch of the discussions there. But, as a business, it's actually quite interesting. Gross margin 77.4%. But at the same time, there's been this increase in dollars lost. The losses are sort of accumulating. Jason, what do you think about, this sort of market? It is a SaaS play, but it's sort of an infrastructure company.
Yeah.
How does that play out?
CloudFlare is, I think, a great company, and clearly they've done extraordinarily well. We've been tracking the company for quite a while. They're probably a 250 million-ish run rate business. They've raised a fair amount of capital, over $300 million to get there.
Yep.
I always look at that, kind of the amount of capital raised to the run rate of the business. And they still are losing money. So there's definitely, the question for me is really ultimately long-term, do sales and marketing costs increase as a percentage over time? Or are they getting some real leverage from the scale of the business? I haven't quite seen that yet. So I think it's a great business, big market opportunity, good fundamentals, but a little less capital efficient perhaps than we've seen in some other companies.
I'm curious what they'll actually end up pricing on day of. So like just for comparison's sake, Slack priced $26 a share, CrowdStrike $34 a share, and Zoom $36 a share. And I can't remember off the top of my head, but Zoom had set their price range much lower than what they actually ended up pricing at. And that this may very well happen with Cloudflare just because there is so much demand for SaaS stock in Wall Street.
Yeah, I think there's been lots of arguments over the years of whether that's a good strategy or not to have a big pop the first day, right? Because
we talk about that endlessly,
leaving money on the table, right, for your shareholders. But
never-ending debate.
You guys tend to cover and say it's been a great, it was a great successful IPO, and there's a lot of positive energy around the company from that. So the direct listing, thing is an interesting thing for Slack because they didn't have that because of the nature of the way they approached getting public. I think that we're going to see more of that going forward.
What's your take on IPO pops?
I think that the ideal is like a 20-30% pop. So
not an 85%
not a 100%
pop.
one, which clearly means you underpriced it. But there's a game being played here between the bankers and their institutional investors that they work with multiple times. And it's really hard to know. Having been through it now several times, it is super hard to know. It's not as transparent as you would think.
Well, and one of the things I always bring up, it's one thing when we look at Uber or Lyft where it was a new business model and it's sort of hard to evaluate. But in SaaS, I mean, there's now dozens and dozens of public SaaS, publicly traded companies. How is it still the case that you look at a place like Cloudflare and it's like, well, there's a huge debate on, is this a quality business? Are these numbers look good? Because you have such like reference material. You have so many ways to evaluate and comp those sorts of numbers.
Yeah, fair enough. I think most people that would look at the numbers would say it's a really good business. I think the only question is valuation at this point, right? No question in terms of growth, market size, and product value prop. They've done a great job. I think Datadog is even more interesting in some ways. I'm sure we'll get to that, but I think over time you're really looking for companies that have a competitive moat, right? And I think back to Slack for a second, one of the overhangs on that stock is competition, right? With Microsoft and others that are essentially giving away similar kinds of products. So that's another factor that you have to take into account is what is the competitive mode of this business over the long haul.
So let's move on then to Datadog, as you said. So Datadog is a company that filed to go public in late August. They are a monitoring and analytics service for developers and IT ops teams. I think overall we saw some pretty healthy financial results from Datadog.
I read this and I was just shocked at how, I mean, people. I'm from New York, and so people always say, well, New York companies, where are the IPOs or whatever. Not only do we have a great IPO, it has got to be one of the best SaaS kind of companies in terms of the metrics and numbers. Just to pull some numbers out of here, net dollar retention rate, which is a good kind of basis for both customer expansion and low churn, was 151% in 2018, and that was up from 141% in 2017. And so just from the basis of this company, I forget its top line revenue off the top of my head, but extremely strong growth, and it's actually not that old. I want to say it was 7 or 8 years into the play, so it's in really good shape.
Yeah.
And I think it's also raised around 300 million or something like that.
Yeah, and as you point out, I mean, that net retention number is kind of best in class. Like 120-ish% is probably pretty typical for a lot of SaaS companies that are well run, land and expand. But 150% means you're growing essentially 50% with your existing customer base. And so every additional sales and marketing dollar, you're now adding to that growth rate, which is why I think you see higher growth rates in this company than CloudFlare, which had lower net retention, right? 110%, 115%.
So the company posted 153 million in revenue in the first half of 2019. Last year, they hit nearly 200 million.
And they've raised only 150.
150, there you go.
Yeah.
Even better than my knowledge. So, the best part about this also is the operating loss for this company is less than 10% of revenue. So not only, are you seeing really good NDRR, but the actual losses is sustained by this company. I mean, they're just not hemorrhaging money in comparison to, say, WeWork, but there's something really valuable there on the sales and marketing where they are being efficient with capital. And I think that's going to be a pretty strong debut on the markets.
Yeah, the other thing to remember with SaaS businesses, these are recurring revenue businesses, right?
Yeah.
So, not only are they capital efficient, but the quality of that revenue is extremely high.
Yes. Well, and I think it's also a great example of a company where, in the monitoring and analytics space for developers, I mean, there was a lot of competition. I mean, there was a lot of entrants in the space, both, kind of after them, but also their peers. And this is just a singular company that sort of broke out between all of them. I mean, it just sort of was a workhorse and moved forward. So it's just super great coming from New York to see such a strong company get kind of attraction like this.
What I love about the developer space in particular is great products win, right? Because, I mean,
exactly.
they know
That's
the
right,
product.
right.
And so, you go to a company and they have that Datadog dashboard up and it's running their business. And the whole area of DevOps is interesting. That's become obviously much more important for all companies, is making sure these websites stay up, right? Slack had some outages and stuff. So things
we had an outage overnight. We lost DNS for like 4.5 hours.
Yeah, and it hurts, right, when it does. So the importance of this for all businesses today is growing. So I am a big fan of that company and the potential.
Taking a quick distraction break. I mean, are you looking in the DevOps space? Is that still an attractive place for us?
We have started to look at it. We looked at PagerDuty. We kind of missed that opportunity. I think that was another great company, another great example of like keeping things up and running and reliable is how important it is today. And that company's been like incredibly successful. So.
Is there, I mean, that's a great example, between Datadog, PagerDuty, and a couple others. I mean, is developer tools fundamentally just a better SaaS play, right? Are developers more loyal kind of customers, more likely to do a land and expand? Yeah. Is there a thesis there almost of like they're just better customers in general compared to SMB enterprise?
Good question. I don't know that they are long term. I don't think they're that loyal actually. I think they're very focused on actually trying new things all the time. And so I actually think to build a sustainable business in some ways you need to get out of pure engineering and development. So Slack started out selling into the engineering development side and then moved into other parts of the organization. It's a great place to start. I'm not sure ultimately, there's a ton of great products always coming out. And the other thing you're dealing with is a lot of not invented here. Like developers think they can build it themselves. So you're selling against, a team internally that's saying, you can't charge me much because if you do, I'm just going to build it myself.
Well, moving on. Not all SaaS companies have the best of luck on the stock exchanges. So we want to talk a little bit about Box because there was some very interesting news about the company this week. So Box went public years ago. I believe it was 2015.
Right.
And this week, it was reported that Starboard Value had taken a 7.5% stake in Box. And Starboard is a company that tends to invest largely in underperforming stocks.
That's right. So in the last couple of years, Box has kind of had huge swings in sort of valuation. I know, Jason, I think you were the lead investor for Emergence, or Emergence was
Yeah,
the
I
large-
was, and we were investors since 2011.
That's great. And we actually have Aaron Levie, hopefully on stage. Hopefully
do,
he shows up. I think this is his first public appearance post the Starboard Value news. But, Box has had a huge kind of roller coaster. I mean, it had some really good years. The last 6 months has also declined quite a bit. What do you sort of think the stock of the company today? What's sort of the future for them?
Honestly, I think Box is one of the most underappreciated companies out there. And I think some of it is deserved because they have, the growth rate hasn't been quite as high as they would have liked, and they haven't been as capital efficient. They were one of the first SaaS companies to really go after the enterprise. And it's a very expensive proposition. So they had Dropbox at the low end, and they had Microsoft, obviously, as competition as well. And so they had to put a lot of energy and resources into executing well in the enterprise, which they have done. I mean, we invested, it was a $10 million revenue business, and they're going to be over $700 million in revenue, this year.
Wow.
I mean, they've grown tremendously. They have a stellar team. Aaron is a truly exceptional leader, I think. But we are entering in this new era of activist investors in SaaS and cloud companies. I think that's the first time I've heard of that happening. It'll be very interesting to see what the impact is.
And you expect to see more of that?
I hope not.
And explain to our listeners why that's bad.
Well, I mean, these guys are not known necessarily for long-term, investing. They're known for getting in and trying to cut costs and find ways of generating a quick return. I mean, that's the way they tend to run. So in a business that requires a lot of upfront investment for a lot of long-term value creation, I think they're not necessarily the best fit. This is my own opinion, but we'll see. It'll be an interesting thing to see what they do.
Absolutely. And I think particularly the SaaS space, it not just, sort of the, maybe vulture capital is a little too aggressive, but, we actually have a lot of other more aligned firms like Vista Equity who've come in with their own playbook. They sometimes buy companies. And in some cases, you have a SaaS, let's call it a median performer. Sales and marketing might not be good. Growth is a little anemic. And, they can kind of execute a playbook and suddenly the company's growing quite a bit. But I think here I'm with you. I think, slash R&D, slash some costs, sell this off, junk it up, and they're going to try to get their 15, 20%.
Yeah, I'm not sure how that plays out, to be honest with you. I mean, that may work in a retail company, but for technology companies, that could be death.
Yeah.
So.
Well, we wanted to compare and contrast a little bit with another one of your investments. So Veeva is a company that not a lot of people know about. We talked a little bit about this before we taped. But yeah, I mean, this company has performed incredibly well on the stock exchange. When did it go public?
So Veeva went public in 2013, and we were investors in 2008. So it took about 5 years to get to
And what
IPO.
is Veeva?
Veeva is actually a really interesting company that not a lot of folks know about because it sells just into the pharmaceutical industry. So think of it like Salesforce.com for pharma. And they were one of the first to say, we're just going to focus on one kind of customer and one industry and build solutions that are really specifically purpose-built for that industry. What happened was they added a tremendous amount of value for those companies because it was really created for those companies. Pharma companies are huge, profitable, and it matters a lot, to them. So they were able to extract a lot of dollars from those companies. So they have a tremendous amount of market share. I think something in the order of 80% plus of pharma companies now use Veeva to manage their sales organizations. And they've produced additional products now that they sell into them. So the land and expand economics there are extraordinary. But the most amazing thing about Veeva, and people don't know about it because they didn't raise a lot of money, and so they didn't have a lot of media following all these, fancy valuations. But we invested $4 million in that company. They never raised another round, and they're now a 25.
They raised $4 million in total.
And they're now a $25 billion market cap company. So it doesn't get a lot of coverage.
That's capital efficiency.
But that ratio might be unprecedented, actually.
So did you just do their seed, or was it a Series A?
It was an A, yeah, which we led, and we were the only investor in the company.
Wow.
Which was really nice. We're still involved in that company, by the way. It's a $1 billion run rate business today. When we invested, it was less than a few million.
And what was the valuation when they went public?
About $2.5 billion, I believe. And they're
Some
25
nice
billion.
returns.
Yeah. And so it's been a 10x since they went public, which one of the beauties of these businesses when they're working and they're compounding is Salesforce went public. It was $1 billion market cap company, and today it's 150 billion. So the post IPO compounding value here can be quite extraordinary. And we've stayed involved. My partner Gordon Ritter is still chairman of the board of Veeva and very actively involved. The other thing to know about Veeva is their 27% net operating margin, in addition to growing at 27%. So they have this beautiful growth and profitability, which is quite unusual.
Well, absolutely. And the other thing is, I mean, just looking at the stock chart here, it's
beautiful.
it's like this beautiful curve you do in like Adobe Illustrator. It's like there's no like ups and troughs.
It's all green. It's completely green.
We just don't see that often. I mean, compared to Box or whatever, they're just sort of ups and downs. But let's look more broadly. We talked about a couple of different SaaS companies, but like I said, I called it a pullback, and I think you're right, it's at 10%. But what's sort of happening in the SaaS and cloud space in general? I mean, are investors still have a wide appetite for a lot of these companies, or are we starting to get to a point where, God, it's saturation? Now there's dozens and dozens of companies. It's hard to tell the difference between this, that, and the other. Microsoft and Google are getting into a lot of these categories and are being, the trillion-dollar company competitors. How do you see the macro scale today?
Yeah, it's so we're still 100% focused on enterprise and cloud. So we obviously still believe there's a ton of value to be created there. What we have seen is there are definitely a lot of Me Too companies coming out and taking thinner and thinner slices of functionality in the enterprise. But that's also being disrupted. Some of the really kind of original phase one SaaS companies are starting to think about what's next. And for us, this kind of user-generated focus, consumer focus on product, AI and machine learning, mobile-first applications, these industry-specific applications that can go after different opportunities like financial services and others. I mean, we still think that there's a ton of opportunity. And the nice thing is, for the companies that are working, the capital markets are there to fund the growth. We hope they're as capital efficient as Veeva. That would be the best. But if they're not,
can't all be.
They can't all be. Zoom was another one that was extraordinarily capital efficient. But the capital markets are there to fuel this growth. So we're as bullish as we've ever been on the opportunity.
How do you feel about the translation from private to public? Is there still this kind of overhang where you kind of go and hit a wall as there's just a different set of metrics and kind of multiples, or do you think that there's sort of a beautiful continuum today in the enterprise sector?
It's certainly not a linear continuum. I mean, I do feel like the later stage private markets have gotten overheated in some ways. And fewer companies actually are going public today compared to, let's say, back in the 2000s, right? So we had 300 or 400 IPOs. This year, maybe we'll have 100, right?
Right. But even though it seems like things have stepped up quite a bit.
But they're bigger and they're more mature and they're raising more capital. So it seems like, we have this IPO frenzy, but it's really just fewer and higher quality companies. I think ultimately it's good for companies to be public. It's just more accountable kind of to shareholders and customers. And from a branding perspective, it still has a lot of value. So Zoom didn't need to go public. It had plenty of cash. They were cash flow positive. There was no reason to go public other than the fact that I think Eric really felt like it would help his customers feel more comfortable about betting on Zoom as a platform.
Well, before we close out, I just want to hit on just a couple more trends we're seeing at the very, very early stage of startups. Like we talked about, there is this whole fleet now of productivity tools, prosumer tools, these B2B companies that want to help developers and employees do their jobs better. So I'm curious, what have you seen? Is this a trend that you're interested in? Are these valuations of these sort of new age working tools justified?
We're all about like the future of work and helping people be more productive in their jobs, and software by far has been the thing that we think has the most potential positive impact on that livelihood. So for us, it's really is about like end users being delighted by these products and saving them time and taking away the drudgery of some of their job to make what they do more creative and interesting. And we have a thesis around what we call coaching networks, which is kind of the marriage of software and human beings and creating kind of real-time feedback in your job. For instance, if we were talking like, what would you like to write about? It would pop up, 3 stories, right? That maybe you should be focused on this. And you would say, oh no, those are the 3 that I wanted. And it would learn actually which kinds of stories you like to write about and why. And so like, wouldn't that be cool, right? And so all of our jobs hopefully will be becoming better and more fulfilling because computers and software will be smart enough to help us make us smarter.
Well, but will the artificial intelligence agent be nice Because we get feedback all the time. I get
Yeah.
emails. We get iTunes reviews
Yeah.
about my laugh. Apparently, it's too loud for people, and poor Chris has to cut
That
it
was
down.
on purpose.
It'll be nice if I have anything to do with it, Danny.
Yeah,
but,
exactly.
but-
When I see a review from Jay Green Emergence, I'll know where it's coming from.
Okay, great. Well, let's close out then. Thank you so much, Jason, for joining us, and good luck on your panel in a few minutes. And thanks, Danny.
Thank you so much.
Thanks, Kate. Thanks, Danny.
Bye.